Good morning to our wonderful audience and welcome back again to Boutiques on Wednesday. It's very chilly where I am. I hope you're keeping warm your side. Global equities bounced back strongly in May, and of late, SA bonds performing strongly as well. The earnings outlook for global equities suggests that the trend can remain. We know that the ECB started with their rate cutting cycle, and despite some inflationary risks that remain here and there, it's only a matter of time before other central banks follow. We obviously stopped saying when, who will cut. We've learned our lessons, but we know we are entering a cutting cycle soon. Both these asset classes can perform very well in a cutting cycle. And here to share his views on SA bonds this morning is the well-known fixed income manager at Methodical Investment Management, JP du Plessis. Good morning, JP.
Good morning.
And joining him as well, all the way from the US on global equities, managing director at GinsGlobal, none other than Anthony Ginsberg. Good morning, Anthony. How are you?
Great to see you, Eugene. Good morning.
Fantastic to have you with us. I believe very late evening there by you, just about 11:30. So thank you so much for your time, getting a long day on your side. But thank you so much for joining us, Anthony. You can try sharing again if you're ready, then you can start and followed by JP. While you're sharing to our audience out there, the Q&A bubble's still there. So if you have questions at any point of time, more than welcome to post it to any of the presenters. Anthony, I've got your slideshow perfectly ready, full screen mode. And if you are ready, we are ready for you.
Thanks, Eugene. Always a pleasure to address your colleagues and audience. Greetings from the land of California, where restaurants are busy. Cars are being bought and sold all day long here. A lot of EVs on the road, and we don't see any sign of a recession at all. So I'd say welcome to the land of the soft landing. I have a couple of slides which I'll go through about the outlook for the US and the fact that the PE ratios aren't as severe or as expensive as many of us are reading in the papers. Once you extract the Magnificent Seven or the so-called FANGs out, actually the PE ratios in America relative to the S&P 500 are just slightly north of 20 and not particularly expensive by historical standards. So we can get into that, Eugene. Happy to take questions. Initially, I just wanted to address what we're doing with you guys at BCI. I wanted to thank you for your support. We're almost at R1 billion over the last year and a half, 2 years on the MSCI World Global Equity Index Fund with you guys. I'm going to try and just go through very, very briefly and summarize what we're doing with BCI. We have the Global Equity Index Fund is tracking the MSCI World, which is just under 70% US-centric, and it's worth addressing why it's not a good idea to exclude the US. So it's worked very well for this fund. The fund is up about 11% year to date, and we cover about 1,600 developed market shares from 23 countries. And on the index tracking side, we actually work with a 200-year-old firm called State Street. It's been a partner of ours for 24 years almost now. And we also have offices in South Africa. We work with Eugene and his colleagues very closely. So thank you for your support and many of the IFAs and other supporters on the call this morning. The fund has performed very well over the last year and a half to 2 years, but it's actually a 20-year-old fund. Just to show you what the revolution is that we're living through here in the developed world, particularly in the US. State Street is one of 3 of the 5 largest asset managers in the world today, 3 of which are actually passive, or we call them index fund managers. And you can just see on the chart over here what has happened over the last 2 decades. It's been a massive revolution in growth in passive, which is the blue line in indexing, which essentially has had significant inflows while the active performers, active fund managers in America have really struggled. This is a particularly US slide, and it just shows the cumulative flows in trillions of dollars. About $6 trillion have flown into passive, and almost $2 trillion has gone out of of active. So it's been a big trend, particularly amongst institutional fund managers and large pension funds such as CalPERS and the like. This is just another slide showing you how, when we started off in the early 2000s, indexing was still dominated by the active portfolio managers, the so-called star fund managers, the Ronaldos and the Beckhams of the world. Today, we don't hear too much about the equivalent of the Peter Lynch's, Bill Miller's, or these are names that were touted for many years that could beat the S&P regularly. Today, many of the big firms here who we collaborate with, and there's a real cohabitation between active and passive in this country. No one's bashing each other. Essentially, people recognize that there's a collaboration. Most portfolios at the large institutional and retirement platforms, 401k platforms, are utilizing a blend of both. And just in green, you can see, just to summarize what's going on there, is the significant growth since really the great financial crisis, 2008, 2009. It stepped up. A lot of the star fund managers had a very tough time, and things like hedge funds and other things generally fell somewhat by the wayside. And passive has become really a core portfolio building block, particularly in the equity side, but even on bonds as well. This just shows you specifically outflows that have occurred over the last decade or so in the US. In blue, almost every single year, we've seen outflows out of active fund managers and inflows into the indexing world. That also relates to ETFs. So the red part are index funds and ETFs. And a lot of it is S&P 500, but other key cornerstones or building blocks in mainstream portfolios, including MSCI World, global bond indexes as well, Russell 2000, things like that. So yeah, it continues, and we've seen the trend into 2024 stay much the same. And perhaps this is really the reason why, increasingly with the rise of the internet and transparency, more and more IFAs in this country, I would say, also fund platforms, have been able to utilize Standard & Poor's, Morningstar, other data sources to show just how few US fund managers over 10 years, 20 years have outperformed global indexes as well as domestic indexes. So here you'll see over 10 years in yellow, 91% of US fund managers have a miserable track record outperforming the S&P Global 1200, which is very similar to the MSCI World that we track. And basically 91% have failed to outperform. That's over 10 years. Over 5 years, it looks slightly better. In 3 years, maybe. But again, it's sort of picking a needle in a haystack over here. It's very risky to try and find the consistent outperformers. There are outperformers every year, but those change continually. So it's never generally the same 10 or 13% of guys who are outperforming. If you look over 3 years, about 12, 13% did outperform on the Global 1200. When you exclude the US, the numbers are generally not dramatically different. Even going down to emerging markets, you'll see close to 89% of American fund managers are not outperforming. This is the S&P emerging markets. So very, very difficult to consistently outperform the index. That's the reason why a lot of the boys here and ladies have basically, I wouldn't say they've thrown their hands up completely, but they've embraced this combination of active and passive together. And specifically on the US S&P 500 and the large cap, the mid cap, the small cap that we're showing over there, over 10 years, it's north of 80%, sometimes north of 90% of US fund managers really struggling to outperform. So they've had a significant market share loss, the likes of T. Rowe Price and Fidelity and others, in terms of inflows that they've really suffered. And the beneficiaries have really been, Eugene, the top index players, people like BlackRock with their iShares, State Street, who we work as partners with, and then Vanguard, who many of you have also heard of. And both in the index fund and in the ETF wrappers, you see this continuing to bear fruit. So the South African story is this. We've taken this from some Morningstar data. And if you go back over 1 year, 3 year, 5 year, and 10 year, and you look at the South African underperformance relative to global equity, it's much the same story. It's well into the 90% bracket or range of underperformance, sadly. But this just mirrors what we're seeing overseas. So the South African fund managers are actually no worse than their US or European counterparts, which I'll get to in a moment, in terms of underperformance. It's just a very, very difficult, challenging world. I've mentioned this before on calls where in the old days, perhaps things weren't as transparent. Also, the rules of insider trading didn't really exist maybe 30, 40, 50 years ago. The golf course was a great place to get tips. Those days are really long gone, and people have to be very careful to front run any stock tips. So I think that's part of the reason, given the disclosures and the increased regulation, is incredibly difficult to outperform broad indexes. This just shows you quickly on the European side. I've circled in red there with my colleagues US equity and global equity. It's showing essentially over 10 years, 94% for US equity underperformance. Again, this is Europeans underperforming. So it's much the same as the South African percentages. Very, very difficult to pick the needle in a haystack. And people say to me, but what is going on here? Because there's this idea that stock pickers do win out. But what is often not reported in the press is that up to 70% of non-performing or underperforming funds are closed every decade. We have a slide that will be coming up. It basically shows in the US, according to Morningstar, that we see a majority of underperforming funds shuttered or merged every decade. The same way you hear of many ETFs often closing as well. So really, at the end of the day, this core versus explore approach is where indexing thrives. It tends to be utilized as the core building block, let's say the bottom piece of the pyramid, or the core of a portfolio. And around that, we see a lot of active satellites, maybe small caps, maybe some more aggressive types of structures. So they can work in tandem. And ultimately, indexing does bring down the average cost of the portfolio. And that's also a big reason why we see DFMs and other large IFAs, wealth managers, multi-managers, embracing indexing to provide an average lower cost for their portfolio. Just a couple of last quick slides, Eugene. This just shows the, again, over a 10-year period in yellow, just how few rolling successes there really are. This shows about a 10% rolling success rate for fund managers in yellow over 10 years. Over 5 years, the percentage of fund managers outperforming a global equity index is slightly higher in orange. And then basically you see over 1 year, maybe there's a bigger chance of outperforming, but it tends to, in the law of averages, ultimately reside in where the yellows and the oranges are. It's less than 20% of active fund managers consistently outperforming, sadly, particularly on MSCI World and the global equity side. What we've had an experience with you guys is that over the year-to-date number is actually now, just to update it as of the end of May, it's actually now just over 11%. And the tracking area is very, very tight. Part of that is that there's no, withholding taxes are a big, big deal in indexing. No one talks about it much, but when you are utilizing a massive firm like State Street, our partners, they are able to reduce the withholding taxes across these 23 developed countries. And it's an important point because it allows us to actually have a tracking area that is incredibly tight. And we don't suffer the 30% dividend withholding taxes out of the US or out of some other countries because of State Street's extensive tax treaty application. So that's just something that doesn't get discussed too often, but it's important to look at finding an index tracker that's got very, very tight tracking error. Ignoring the US comes at its peril, because what you see in yellow there is what the MSCI World has done over the last decade and a half. And if you excluded the US, you get the blue line. You get a much flatter, more boring return. So given my past experience on Wall Street and also working for one or two British banks, when they perennially underweighted the US, they often felt like they were still fighting the War of Independence, the Brits against the Americans from 1776, and always talking about the PE ratios being too high in the US. What actually happened was they tended to historically always underperform. It's very difficult to time getting in and out of the US market. So that's probably why we say MSCI World remains a very, very good benchmark. You can always underweight the US in other satellite that you may surround your core with. So what's important is also look at the last 10 to 20 years. How often have international stocks outperformed the US? And the answer to that is in orange. only those orange bars are the cases between 1973 and 2022 when international actually beat the US. And you can see the last decade or more, the US in double digits has actually in yellow outperformed. So if you look at 2021 or 2018, I mean, these numbers are around 9-10%. 2021 shows 17.5% outperformance. Essentially what this is the differential between international stocks minus US stocks. So ignoring the US is a very risky crusade. What it says is US has actually outperformed international stocks 8 of the last 10 years. And given what's going on with the Magnificent Seven and others, it's hard to see, given the soft landing as well in the States. We're expecting GDP growth here of about 2.5%. So things remain healthy and relatively optimistic, I would say. So that's a good segue just to summarize our outlook. We see Fed rate cuts probably after the election at the end of the year in December. It's too politically sensitive to probably do a rate cut just before the election for the Fed. But there is a sense that inflation is coming down. Actually, the stickiest part of inflation is not the manufacturing side or goods. It's actually the services, areas such as insurance in this country and other levels of service that have been rather sticky. Unemployment, you just saw the jobs number late last week it sort of blew away the expectations. It was almost 300,000 new jobs, and the unemployment rate ticked up marginally to just over, it's around 4%. So we're at a very positive outlook for the US. We will follow the ECB and probably the UK central banks in lowering rates. But what that means is you're going to have a stronger US dollar for a little while longer. Many people have been talking about the impending doom of the US dollar. I think that is somewhat short-sighted at the moment because we will be later in dropping our rates here. This just shows you that the US has not been the best performing market. Certainly last year, Japan blew everybody away. The emerging markets are finally starting to show some gains. And again, trying to time these different markets is incredibly difficult. Europe has actually had a pretty good run recently. In orange there, you'll see the Europe stock 600. We actually incorporate that and the S&P 500. Essentially, these are all incorporated in the MSCI world. So, we're not taking a bet on one versus another, but it's important to say we don't cover emerging markets or China in our MSCI world. It's all developed markets exclusively. We have a separate emerging market building block that people utilize typically. Last couple of slides just shows that all the growth in 2023 largely went to the other 7 Magnificent Seven rather than the 493 holdings in the S&P 500. So most of the US market has not fully run yet. That's why we say the PE ratios are relatively inexpensive at just around 20 times earnings when you extract and pull out the Magnificent Seven. So it's really been a very, very narrow market. We don't feel that the market is overvalued here when you look at the remaining 493 companies, particularly given the consumer sentiment being somewhat positive, more tech spending coming through. We expect a broadening, frankly, of tech earnings beyond just the 5 or 6 companies we all talk about, from NVIDIA to Apple. And the fourth industrial revolution is happening. The usage of work from home, online media, streaming. I mean, most families in this country now are cutting their traditional broadcast TV or cable, and they're all using 3 or 4 streamers like Disney Plus, Netflix, and perhaps a third or fourth one like Hulu or HBO, and they're still saving money by doing that. So there's a huge trend towards that, also towards gaming and cloud usage. And I would just say that things like cybersecurity and cloud are increasingly merging together and are like basically brothers. But the use of people working remotely, and also the number of fast charging EVs. My own building, as a quick example, just to summarize, we only had 2 or 3 EV charging stations under Trump. Today we have 25 in my 10-story building here in LA. You see a lot more EVs on the road, and we have to give Biden some credit for passing the $1 trillion infrastructure or IRA Act. You've seen that they're keeping Chinese EVs out with this 100% recent tariff. But there's a concerted effort here to build out more clean energy and charging stations across the country. This was just briefly included just to show you how narrow the market gains have been. And if you exclude these guys, essentially the rest of the market has been somewhat flat as a pannenkoek, as we used to say when I grew up many years ago at UCT. This just summarizes really how the Magnificent Seven PEs are at close to 40 times if you take a weighted average of them. But there's a ton of money sitting on the sidelines, Eugene. And to summarize, there's about $7 trillion just in money markets alone that probably needs to find a home in equities. And as rates go down, that money is expected to flow out of money market and these temporary cash balances. And 401k plans, as you know, is a monthly tsunami of money that comes in from the retirement community through all workers' accounts here. So I think with that, I'll just turn it back to you and thank you, and just say to my fellow South Africans where I grew up that if the UK only in this slide shows 20% domestically invested, it's just an interesting statistic relative to South Africans, because the UK investors at this point, it shows, are only really putting 20% of their own money into their own market. So it's just an interesting comparison figure. Thank you very much for your time.
Anthony, very interesting indeed. If you can maybe stay on the line, there's a couple of questions. We'll get to that just now. Next up, JP, we've got you. So Anthony, if you could just unshare, then JP can put his slides on. There we go. Yeah. JP, you should be able to share. Yes, coming through.
How are we doing?
Yeah, perfect.
Is that working? Do I need to change the...
Yeah.
There we go. How's that?
Perfect. Thanks,
okay.
JP.
Technology. Okay, good morning, everybody. On a cold Cape Town morning. I thought I'd warm you all up with a bit of discussion on bonds and, just try to sort of paint the opportunity set in bonds and why I think you should be invested, but also be invested via a fund manager who does the active allocation for you rather than a static allocation to bonds. So bonds have actually, at periods in time, produced really attractive returns. And you see lots of stories in the press about how attractive bonds are at various points in time and how SA managers love bonds, etc. But if you look at it, if you look at bonds over a very long time frame, then bonds have actually not done very well, and they've actually done poorly if you look at them on a risk-adjusted basis. So if I look all the way back to 2000, a long period of time, the all bond indexes returned 9.6% over that period. The average multi-asset income fund has produced 9.1%. So bonds have done better, but bonds have done that 9.6% with a much higher volatility at 7.4%. Versus the 2.5% of income funds. I just added the cash numbers there as well. So the point there really is not that bonds don't produce decent returns, but that they can be volatile and that they really need to be actively managed. The next slide just talks about bonds performance over cash. And you can see there have been some really, really strong years. If you look at 2012, look at 2016, bonds have significantly outperformed cash. You can see in 2012, they did more than 10% above cash. But there have also been periods like 09 and 2015 where they significantly underperformed cash. So there are times where you want to be in bonds, and there are times when you don't want to be bonds. I mean, I think this discussion is great that we're having it on the Wednesday before Parliament starts, because what we've seen month to date is an extremely strong performance of our bond market, up 2.5% month to date, as people get very excited about the government of national unity. But if we were to see some wobbles in that process, we could well see some of those gains given back. So what you do need is you need a manager who's sitting on his Bloomberg, looking at the market, taking some profits when bonds run very strongly, and then maybe adding when there's some weakness. There's there's a participant in the bond market that doesn't necessarily profit maximize. So there's a very large participant in the bond market which doesn't profit maximize, and the non-profit maximizing participant is National Treasury. So National Treasury is a big supplier of bonds to the bond market, and their real focus is making sure that they're funding the budget deficits, and that they're doing that funding without rollover risk. So what is rollover risk? Rollover risk is suddenly there's a stop in financial markets like we saw in COVID. You go to the market to try and fund yourself, and all of a sudden the market's closed. So what that means is that National Treasury looks to borrow very long dated and stop itself from having these potential risks of having to refund itself. Anthony, who sits in the US, the US government has a very different approach because they are the reserve currency of the world. They can afford to roll their debt very short, but as a small company, a small open country, we need to make sure that we fund our debt long, and that can put pressure on the long end of the bond curve. So what you see here is the spread of the 2048 mature in 2048 government bond versus the yield of the 2030s, which matures in 2030. So it gives you a sense of where longer dated bonds spread is versus shorter dated. Used to be the 10-year, but now it's the 7-year. And you can see when we have periods of large amounts of funding, we're running big budget deficits, that puts pressure on that longer end of the curve. If you're just statically invested in the all bond index and you're not managing that process, then as the bonds are issued, the all bond index gets longer, and you have to buy those long dated bonds, whether they're showing value or not showing value. So that's something that as a bond fund manager you need to kind of assess whether you're being paid sufficiently for the sufficient premium for that extension of term, extension of duration. There are lots of other things that as a fixed income manager you can be invested in South Africa. There are lots of places to hide if you don't think bonds offer value. So what you really want is a dynamic bond fund manager that can take advantage of bonds when they're showing incredible value, and then also a bond fund manager that can find places to hide if bonds aren't showing particular value at any point in time. So I've already talked about active curve risk. That's just talking about being in the front end, being in the short end of the curve, if you're getting paid to be in that, and the risks of being in the longer dated bonds aren't compensating for the returns, aren't compensating you for the risks in being those. And I'll show you an interesting couple of curves that illustrate that. Then there's things like asset swap spreads. What's an asset swap spread? Basically, it's a government bond where the duration is hedged out using interest rate swaps, and that reduces the duration risk, but you still get the spread that the government has to pay over where interest rate swaps are. There's things like swaptions where you can use derivatives to get exposure to duration. You're exposed on the upside potentially, not on the downside. There's yield products, there's credit, and then also potentially currency at extremes. In particular, I think our currency has behaved quite well over this election period, but equally it could have performed badly. So currency tends to having some hard currency in a portfolio tends to be a bit of a hedge to risks in the portfolio. So I thought I'll show you as an example the two versions of our government bond yield curve. The one is going back to the beginning of 2009. The blue line, believe it or not, is what our bond curve looked like in the beginning of 2009. The interest rates were much higher. The market expected interest rates to come off, and there wasn't that funding pressure that we see now. Remember, we're in a period of a good fiscal period. So in effect, you weren't getting paid at all to take term exposure in the government bond curve. That's quite an extreme position. You can see in the red is where we are today, at least a couple of days ago, where as you get into increased amounts of duration, as you get into increased amounts of term, you're getting paid for that risk, and you've got to identify where on that curve you think you're being adequately compensated. But this curve does move around a lot, and we've seen, as I said, quite a significant rally over the last few days. So you really need to have an active fund manager that's moving the exposure. So in conclusion, what we have at Methodical is currently called the Methodical BCI Bond Fund. We're actually in the process of renaming it to just to give investors a bit more sense of the more active nature of the bond fund. We do think there's good value in bonds as we sit here at the moment, but we want to be able to be more active in the space. So it's not necessarily that you have a static kind of all bond index exposure, but that we move it around. And then, you know, if we go back to a few slides ago, what we really want to be doing here is you know, taking advantage of those big up moves in bonds without suffering those large drawdowns when bonds don't offer value. So yeah, it's focusing on risk control and actively managing the bond fund. So I'm going to leave it there and see if there are any questions.
JP, thank you very much for that. Anthony, I've got a couple of questions for you, but before we do that, JP, while I've got you on the line, let's maybe start there. Yeah, but bonds, I think a lot of investors are battling with pure bond funds, when to bring bond funds into the equation or not. They've been rather disappointing. You've showed longer term performance, outperforming cash most definitely, or you know, getting close to income funds, but with much higher volatility. I mean, what is the path going forward for using pure bond funds for investors? How would you include that in a multi-asset portfolio? Why not then just still remain with a income fund, a flexible income fund?
Yeah, so it's an interesting question, and perhaps I should have touched on that on the presentation. I think what we've seen in the income space is that it's become income funds have become a you know, catch-all for fixed income investors. And what that means is that you know, that there's some bond exposure, but a limited amount, because you're still trying to satisfy the low risk criteria for income funds. So you end up with this kind of hybrid, which isn't really taking advantage of bonds when there's a lot of value in bonds. It's taking advantage to some extent because that within the risk budget that you can have in an income fund, because remember, people are still parking cash in income fund. So what we do at Methodical is we have an income fund, which is, you know, I kind of refer to it as our widow and orphans fund. It's somewhere you park in cash. You want to get higher than cash returns, but it's not a kind of growth asset that you can have from having more longer term exposure in bonds potentially. So when I talk to clients, clients really need to think about this as a building block for multi-assets. And typically, if you're having a conservative fund, a larger exposure to this kind of active fixed income or active bond allocation. And then obviously, as you go up the curve, you go into more kind of offshore equity, you know, those kind of things. But, you know, you can, so if I think about this in terms of, you know, performance, you know, currently the bond funds yields 11.3, which is CPI plus 6 kind of returns. I would say longer term, our bonds are somewhere probably between CPI plus 4 and CPI plus 5, if, you know, managed correctly. And we've seen with income funds, they've done well, but probably 2 to 3. So, you know, you've got to bear in mind that, yes, you can get better returns. They're going to be slightly more volatile, but as part of a multi-asset portfolio, they make a lot more sense. So bonds might be more volatile than income funds, for example, but they're significantly less volatile than equity funds. And you can get, you know, similar type of returns out of bonds to equities with lower volatility, but you need to be in them at the right time and actively manage them.
Yeah, it makes a lot of sense. In your bond fund, I mean, your benchmark is the All-B. Duration of the All-B is roughly about 7. You can correct me if I'm wrong. Where does your duration sit relative to the All-B? And this also speaks to one of the questions from the audience, from Tavonga. How flexible are you with regards to duration risk in this bond fund?
Yeah, so I mean, it's a great question, and you know, the real focus is still beating the All-B, but doing that in a better risk-adjusted manner. So I'm 0.3 years short of the All-B. So there's still a significant amount of duration because I think bonds offer value, and foreigners seem to be agreeing with me so far this month. But you know, if there are periods where I don't see value, or there are particular parts of the curve that I don't see value, particularly say at the longer end. The longer end at the beginning of last month was at 13% yield, attractive, you know, versus what you're getting in cash. But if we saw a significant rally where the longer end is no longer paying you, you know, kind of cash plus, what is that, 5, and it's and that you know, there's less return for the kind of risk that you're taking at the very longer end, I could have a significantly lower duration in the bond fund. Now, obviously, you know, bonds could rally in further than I think they will, and you know, get kind of more stretched in terms of valuation. So what you're effectively doing is you're cutting off maybe potentially some of the upside, but hopefully more of the downside. So yes, you won't necessarily participate if the All-B kind of, I think, gets very, very stretched. You might not participate fully in all of the All-B, you know, that doing that 10% above cash on a 1-year period. But you know, hopefully, you know, if the valuation kind of methodology works and I do my job properly, then I cut off some of those downsides when we see significant negative returns in the bond.
Anthony, I'm not ignoring you, but JP, I want to continue with this conversation for now. Another question from the audience, from Sean, and you showed, you know, the principle of bonds. You're locking in high yields at the moment. The question then more specifically is, due to your active nature, do you ever hold bonds to maturity, almost to secure that higher yield in principle?
Yeah, look, I mean, some of these bonds are going to outlive me. You know, 2053, I might be retired by then. I'm pretty sure most of the people on this call will be, you know, towards the end of their careers at least. So not always, but I mean, the question, I guess, it's a bit like a Warren Buffett style view of the world is, you know, would I be happy to own it to maturity? Yes, you know, that's got to be the thinking. Would I necessarily do that? No, because you know, if it rallies from 12.5, where we 12.5 today to 8.5%, I'm not going to be holding that relative to what I can get in cash. But you kind of have to have that mindset of, you know, would I hold it? Am I comfortable holding it for a long period of time? Although having said that, you know, I can sell it, you know, in the next 10 minutes. So it's not right that I'm necessarily wed to it, but the kind of mindset when you think about buying it is, you know, am I happy with the kind of risk that I'm taking on given the term of this risk?
Hence, a still an active bond fund. I mean, making exactly that point. JP, I'm going to come back to you with regards to potential risk around nominals and SA. I think a lot of consumers are worried about that. But before we do that, Anthony, you gave us a lot of information. I think the one comment you made is very true. You know, if you ignore the US, it could be a risky crusade, to quote you verbatim. And in your fund, the GinsGlobal Equity Index Feeder Fund, you obviously track the MSCI All Country, dominated by the US. I mean, we all know that. In so many words, your topic, one of your topic lines, you said, you know, the PE ratios, if you exclude the Magnificent Seven, it's just trading slightly above 20. But here's the thing. I mean, if I buy into your index fund, tracking the MSCI, it is still dominated by the Mag 7. Tesla, obviously, well, Mag 6, Tesla dropped significantly. We're not going to go into the Tesla debate. But the question then is, am I not still buying something that is expensive?
Yeah, that's always been the comeback against indexing over the last 30 years, Eugene, that while guys buying Apple, a couple of years ago, or even Microsoft a decade or two ago, the point really is that in MSCI world, the index construction is very different to what we saw in the JSE growing up, well, as I did in Cape Town with Cyfritz and BOE, staying away from it.
Yeah, a long time now.
Yeah, because those guys were active managers. Indexing hasn't really taken off in a huge way in South Africa, partly because of the index construction. In the MSCI world, the largest holding is about 3.5% to 4%. If you look at Apple or an NVIDIA, is around 3%. So it's not the top-heavy Anglos of old or Naspers process that you have nowadays. So it's much more broadly weighted across multiple sectors. So it's a good question. Again, are we going to try and time Microsoft timing the Mag 7? Is people getting fired if they basically have excluded some of those. I mean, Kathy Wood, who we know here in the US is a big tech investor, completely missed NVIDIA. So it's very, very difficult. We've basically, I would say, a building block. People can always underweight these things in other constellations, in terms of satellite holdings. But really, people are utilizing us so they don't miss out on the US and on these various trends. I agree that the MAX 5 may have run somewhat, but again, the total holding, if you look at our top 20% of the fund, it's not dominated only by 3 or 4 holdings. It's very broad. I mean, you've got 1,600 shares in there, and of course, places like Japan are now running, Europe's running. So we expect the US weighting to possibly come down below the high 60s at this point. I mean, when we started off, the US was just about 50%. So things can go back some ways, but it's a fair point. I'll just say that it's very difficult to time these things, and indexing is really utilized as a core building block to lower the fees overall and to not miss out on the broader market, Eugene. So we're not going to always get it right, but at least we cover the full market.
I think that's exactly the point. And I mean, you did mention it in your presentation as well, to have a core holding in a non-active or tracking MSCI, and you can always run satellites around that depending on your views. On that point, we don't host a feeder fund of that, but I do know that you've got an emerging market ETF as well. In recent months, did you see a increase in or uptick in interest in emerging markets in that fund?
Yes, we have, and obviously the fund has started running. Look at MSCI Emerging Markets has a China weighting that also can propel that forward. So if China starts recovering, that fund we expect to obviously outperform. For us, the broadest building block always tends to be the developing world, and then we find guys will underweight or overweight respectively. Even some other regional index funds that we have overseas, like a US fund, we may see guys underweight that and overweight Europe as a touch. At the moment, in line what you're asking me is, yes, they're overweighting emerging markets slightly, but ultimately guys from a place like South Africa, we see want the developed world. They want these 23 large developed countries as their cornerstone, and emerging markets tends to be more of a satellite usage, Eugene, at this point.
Yeah. Anthony, on global equity, specifically US equity, I think a lot of investors are getting a little bit nervous because, I mean, it just keeps going. You almost feel, but we all know there's no party in the world that always continues forever.
Right.
But you also showed in your concluding slides very interesting comments like that 7 trillion still being held up in cash. Good argument there. Whenever the Fed starts cutting rates, and we stopped saying when, that money will likely look for another home. But if you look at US GDP, I mean, expected was 2.5. You made reference to that as well, but it came in a lot lower at 1.6.
Yes.
So and not to get to any long-term conclusions, but GDP definitely slowing down. That was mainly held up by the US consumer
Yes.
to date. And
Well,
the question then is, isn't the US consumer just running out of steam?
Well, if rates remain so high, they would. I would agree with you. And that's actually why the Fed and Powell, the chairman, is under pressure to actually lower rates. I'm sure President Biden would love him to lower rates sooner rather than later, because it will help him in the election is really on a knife's edge, as you know here. The ultimate issue is that interest rates are a bit too high. It's affected the property market. Youngsters can't actually afford new mortgages because rates are around 7%. We're used to levels of 3 to 4% mortgage rates in this country. You can tie it up for 30 years at those rates. Most of my mates in their 40s or 50s have got 30-year mortgages in the 3-4% range. But the main point that you raise is a good one. The American consumer will be under pressure if rates remain this high. We actually think that the GDP coming down to 1.6 in the last numbers is actually another signal that the Fed has to lower rates, because there is a contraction going on. Things are starting to slow. So that's why we expect a number of rate cuts into 2025. There probably will be 5 or 6 rate cuts next year. That will help tech stocks. It will probably help a lot of mid-cap and smaller cap stocks that really haven't grown. We haven't seen the broadening out. And ultimately, I just want one last thing on indexing. The turnover in the index funds is only about 3% a year. So it generates very, very low transaction costs and taxes. And that's one of the other reasons why indexing has a slightly unfair advantage over fund managers and some of these rock stars or Ronaldos of the world that basically are trading 100% turnover in their portfolio a year and adding an additional sometimes 100, 200 basis points extra hurdle to overcome in their costs. So index funds are incredibly goedkoop, Eugene. And I think that's why you see 90% or 85% of the guys underperforming. It's not that we're geniuses in any way, but our costs and our lack of transaction charges makes it incredibly inexpensive.
Yeah, that, and I think that you can partly make a case that indexing is to some extent, you capture price momentum, because as shares re-rate and it falls into different sectors, the index re-rates, your fund re-rates. Question from the audience speaking about things like this, and you've shown some very strong numbers in the uptake on ETFs. Question from Sean: if the US didn't have the tax concessions afforded to ETFs, would passive adoption be anywhere close, especially those numbers that you showed? And if so, is the US reference not a point, not misleading proxy then?
Okay, it's a good question, Sean. Actually, the answer is that Jack Bogle, the CEO and founder of Vanguard, was shooting the lights out before ETFs. He was actually against ETFs, and he was already into the multi-trillion-dollar level at Vanguard, all based on pre-ETFs. So there is a small capital gains advantage for Americans in ETFs, but even in Europe, we see ETFs taking off like hotcakes there. So it's not purely a tax issue. And ultimately, the main benefit of indexing, I would say, is the low transaction costs generate smaller transaction costs and smaller internal tax consequences for fund managers. So it's actually a broader issue. This trillion-dollar train took off long before ETFs came along. It was already started in the 70s, 80s, and 90s. ETFs are really only a post-global financial crisis issue. It's just another kind of wrapper, ultimately, a cheaper wrapper. That's really what it is.
Yeah. Anthony, thanks for that. JP, back to you very quickly. I get this very often when we deal with investors and facing investors face to face. We talk about income funds, we talk about SA bonds trading at super attractive values, all the stuff that you showed now. But I mean, in so many words, if you look at SA's debt to GDP sitting close to 18%, yes, bonds are being issued at yields between 12 and 13%. We know the yields are very attractive. But if GDP is trading at 1%, should investors not be concerned about nominal bonds or government bonds with this country being so indebted and, almost no growth?
Yes. So, I mean, it's a great point, and that's the reason why we're getting paid so much on our bonds, and why foreigners find them attractive. But I think there's always a lot of home bias in the view of the world. in that, we kind of think we get all down on ourselves, but if you look at other EMs out there, they've also got a lot of other problems. So it's a 100%. It's a competitive world for finding funding, and that's the reason why our government has had to pay up for our funding. But just remember also that as an economy, we're not particularly indebted because our corporates are sitting on a lot of cash. So you kind of have to look at a country as a whole rather than necessarily the government debt. So yes, the government needs to get its act in order. The government needs to to find ways to fund itself and also to look at improving growth. But if we get that path right, and obviously this week everybody's getting kind of optimistic about the GNU, the Government of National Unity. But we do need growth, and growth is the best way out of any debt problem. You can grow your way out of debt problem relatively quickly. We need to see some of that.
Yeah, and hopefully we will with the Government of National Unity. Yeah, we'll see how that plays out. Not going to make any more comments on that. Anthony, very last question, and it speaks to your actual returns versus the MSCI. You did explain it in a previous webinar, but maybe you can just touch on that again. You're still outperforming the MSCI and a lot of other index funds, roughly about 2% over 12 months, and that's ongoing. Why is that?
Yeah, it's a great question. The reason is that a lot of it has to do with how MSCI calculates their index return net of withholding taxes across 23 different countries for MSCI World. So they're assuming withholding taxes on dividends of anywhere between 15% to 30% typically. If you use an Irish or a Luxembourg-based partner or domicile, and particularly a large partner that's got tax treaties with all 23 countries, we're able to essentially receive the dividends at a reduced tax rate. So instead of paying the 50-30%, that's really, Eugene, adds probably, I would say, of the order of about 20-25 basis points additional returns annually a year. So it's quite a big savings, and it actually makes our tracking error look far more impressive than if we were just doing it alone.
Very interesting indeed. JP, very last question from Tavonga. What is the scope of your universe outside nominal government bonds? So looking at things like credit and SOEs and other.
Yeah, so it has to be liquid because of the nature of the dynamic asset allocation. So it would only be in high quality banks basically, and government. It wouldn't be going down the corporate credit or a less liquid credit curve. It's not really a buy and hold strategy. It's not really a sort of a credit fund. It's more of a active bond fixed income allocation fund.
JP, Anthony, thank you very much for that. The clock caught up with us, and Anthony, I'm sure you want to go take a couple of wings by now. Very long day for you indeed, and thank you so much for your time. JP as well, thank you very much. Maybe just some concluding comments. JP, your bond fund, so for the audience, if you buy into the bond argument, your bond fund top quartile performance, definitely not a bond fund that can be ignored. So go have a look at that. Anthony, I tend to agree with some of the comments you made. If you're looking for a solid core holding, global equities, your index fund doing phenomenally well, and very low costs. Indeed, your TIC at the moment is just touching on 0.37. So very much an inexpensive way to get exposure to a broad global equity market. Gentlemen, thank you so much for your time this morning. It's always great to have you with us, and we'll hopefully chat to you in the near future again. Yeah, audience, again, just a short reminder, next week, Wednesday, the 19th of June, we are joined by Fairtree and Southern Cross Capital, and hoping to see you all back again next week, Wednesday. Thank you for your continued support from the BCI team. Greatly appreciated as always, and we'll chat to you soon. Stay warm.